What truly happens when the complex machinery of a national or global economy begins to shudder, grind to a halt, and ultimately fall apart? Why do these devastating collapses, which can erase fortunes and reshape societies, even start in the first place? More importantly, what enduring lessons do we as a collective manage to salvage from the wreckage afterward? This essay will explore these fundamental and pressing questions in a clear and methodical way. We will follow a consistent and simple plan for each historical event we examine, identify the underlying cause, describe the dramatic crash itself, extract the critical lesson learned. Understanding this pattern is essential for navigating our interconnected world and building a more resilient future. An economy is a vast, intricate machine where countless individuals and institutions interact. People work together to produce goods, provide services. They buy, sell, save for the future, borrow to build or invest. Money, the lifeblood of the system, flows from hand to hand, enabling transactions and growth. Banks act as intermediaries, channeling savings into loans that fuel businesses and help families buy homes. Governments set the rules, regulations, and policies to guide activity. If one significant component breaks, stress ripples outward, affecting interconnected parts. Small, isolated problems can rapidly escalate into systemic failures. This is how a widespread economic collapse can begin. Fragility is a constant theme through history. A loss of confidence in one area can trigger a chain reaction of fear and withdrawal. A poor government decision can destabilize markets and erode public trust. The same tools that create prosperity, debt, financial innovation, can become instruments of destruction without caution or oversight. We observe the human element, panic in the streets, closed factory gates, desperate families. These are personal tragedies multiplied across millions of lives. This essay demystifies the jargon to reveal the simple truths at the core. Each crash, from the slow decay of an ancient empire to the lightning-fast implosion of a modern market, tells a story of ambition, error, and resilience. By following the path of cause, crash, and lesson, we gain an intuitive understanding of economic stability. This knowledge helps us recognize warning signs and value safeguards designed to prevent them. The economic decline of the Roman Empire was not a sudden crash, but a slow, grinding process that unfolded over centuries, driven by political instability and monetary mismanagement. For much of its history, Rome's strength rested on a stable currency and secure trade. In the 3rd century AD, crisis and civil wars placed immense financial strain on the state. Wars were expensive, and the tax base couldn't cover a constantly mobilized army. Emperors resorted to debasing coinage, mixing cheaper metals like copper into silver coins such as the denarius. At first, it stretched precious metal supplies. Soon, the public saw the silver content dwindling. Faith eroded, prices surged, and trade faltered as money ceased to be trusted. Long-distance commerce shriveled, the economy fragmented into local units. Cities shrank, many retreated to subsistence agriculture. With fewer taxes, Rome struggled to maintain roads, aqueducts, and the military. The lesson: sound money and trustworthy governance are foundational. Sacrifice them for short-term gain, and you undermine commerce and public trust. The health of a nation's money is inseparable from the health of the nation itself. Following its defeat in World War I, Germany faced crushing reparations under the Treaty of Versailles. The new Weimar government, unable to raise enough through taxes or borrowing, turned to the printing press. The central bank printed to cover bills, war pensions, even reparations. Catastrophic hyperinflation followed, prices rising daily, then hourly. Workers grabbed wages twice a day and spent them immediately. Life savings evaporated. Even a loaf of bread became unaffordable. Money ceased to be a store of value. Normal economic life broke down. The social trauma, fear, anger, and desperation was immense. People hauled cash in wheelbarrows. Children played with stacks of notes. Currency was cheaper as wallpaper or fuel for the stove. Chaos fueled extremism and corroded trust in institutions. The lesson is clear. Printing presses can't solve fiscal problems. Uncontrolled money creation destroys wealth. Independent central banks must protect price stability. Money must remain a reliable measure of value, not a tool of political convenience. The The 1920s glittered with apparent prosperity and a booming stock market, buying on margin spread, pushing prices to dizzying heights. Beneath the surface, agriculture struggled and industry slowed. In October 1929, the bubble burst. Black Thursday, then Black Tuesday. Prices collapsed. Margin calls forced more sales as paper wealth vanished. Banks had lent to speculators and invested deposits. When loans soured, banks failed en masse. Bank runs brought down even solvent institutions. With credit frozen, businesses couldn't finance operations, factories shut, and workers were laid off. Unemployment soared to 25% in the U.S. Despair spread worldwide. The lesson: stronger regulation and safety nets. Deposit insurance and market oversight helped restore trust and prevent cascades. Government intervention cushioned society from the worst effects of collapse. Well, that's the hard lesson history taught. In the 1970s, Latin American nations pursued ambitious industrialization, financed by cheap international loans. Banks flush with petrodollars lent freely across the region. Countries borrowed heavily in U.S. dollars, accelerating growth on a fragile foundation. In the early 1980s, U.S. interest rates spiked and commodities fell. Debts soared as incomes plunged. Mexico could no longer service its debt. Others followed, ushering in a lost decade. Lending dried up, austerity bit, and poverty and unemployment surged. The enduring lesson: excessive foreign currency debt is dangerous. Nations need sustainable debt, domestic savings, diversified economies, and orderly debt resolution. Foreign capital can drive development, but reliance on short-term dollar debt creates extreme vulnerability. In the mid-90s, several East and Southeast Asian economies were booming. The Asian tigers, massive foreign capital flowed in, often short-term and dollar-denominated. Poor regulation fueled speculative property booms and excess industrial capacity. Banks and firms borrowed in dollars but earned in local currencies, creating dangerous mismatches. Thailand abandoned its dollar peg. The baht plunged and dollar debts exploded. Companies and banks faced unpayable obligations. Failure spread. Panic swept the region. Currencies and markets crashed. The human consequences were immense. Job losses, business closures, social unrest. Indonesia suffered inflation and shortages. Riots ended the Suharto regime. In South Korea, citizens even donated gold to bolster reserves. The lesson: strong, transparent regulation, better governance, and large reserves. Plus, managing capital inflows towards stable, long-term investment. The 2008 crisis grew from a massive U.S. housing bubble, fueled by low rates and lax lending. Subprime mortgages with risky features spread, under the belief prices would rise forever. Construction soared, home ownership surged, and trillions in precarious mortgage debt saturated finance. Wall Street bundled loans into MBS and CDOs, sold to investors worldwide. Rating agencies often stamped them AAA, spreading hidden risks across the system, a financial house of cards. When prices fell, subprime defaults surged and MBS values crashed. In September 2008, Lehman's collapse triggered full-blown panic. Banks stopped lending to each other. Global credit markets froze. Businesses couldn't finance operations. Spending cratered. A severe global recession began. Millions lost jobs and homes. Some firms proved too big to fail, forcing massive bailouts. The lesson: innovation needs matching oversight, capital buffers, derivatives rules, and safe wind-downs. From Rome's debased coins to 21st century toxic assets, a clear set of lessons emerges. Trust is the invisible glue. Faith in money, in deposits, and in institutions. When trust shatters, economic life unravels quickly. Excessive debt, households or governments, creates fragility. Weak rules invite bubbles and devastating crashes. Diversification and safety nets stabilize economies and societies. Swift, transparent policy contains panic. Study causes, crashes, and lessons to spot warnings. Back prudent policy and build a more stable, equitable future, protecting our jobs, our homes, and our hope.